Welcome to Bunnex Investment Group. By the end of this video, you should be able to 1. Catch sniper entries with very small stop losses, have a clear entry point that can be repeated over and over again, have a simplified approach to the market and can trade any market. So be sure to stick up to the end of the video so that you can fully comprehend all the concepts that we'll discuss. So the market is driven by supply and demand. However, the real driver are the market makers. The market makers are actually the big institutions that are behind or within the trading industry. So these market makers will be waiting for you to do a bad move for your account to fill their orders. We are saying if your stop loss is taken out, it means you provide liquidity within the markets, and that will be able to enable them to open trades within that market. So that is why if you buy, they sell, and if you sell, they buy. If you've come across an endeavor whereby you buy and they sell, the market sells, and when you sell, the market buys, this is the exact thing that will be taking place. For this scenario to occur, they have to convince you to open some positions. Your account is of no use to them if it has no open positions. However, our today's strategy will prevent you from being trapped using the following concept. Here's the explanation of the concept. We have three major sessions, which are the Asian, London, and the US session. Usually the Asian is not tradable. Why? Because most of the times it will be consolidating. And for our strategy, the London is also not going to be traded. We use the London as the primer. By primer, we say it's the first step that we need to see for the strategy to work. And then the US session is the entry session. So we are saying the Asian is the market opener, the London is the market primer, and then the US session is the entry session. By primer, we mean the London will be the session that sets the initial high or low of day. We are saying out of the Asian session range, we will be expecting the London to set the high or to set the low of day, the initial high or initial low of day. So we are saying when London session sets the high or low of day and the market retests that high or low in the US session, while all in line with the bias, it's an entry. So we are saying if the London sets the high or sets the low of day, and then in the US they come back to retest that high, give us a candlestick reversal at the high of day or low of day that has been set with the London, it's actually an entry. Bias is seen by levels counting. We may know the market is in an overall upward direction or overall downward direction using levels counting technique, or you may basically do the layman's way whereby you just need to see a 50 EMA crossing a 200 EMA on the previous day. If the previous day to the day of your observation has a 50-200 EMA, it's a valid bias. A crossover of the 50 and the 200 to the upside, it's buy bias, and the vice versa is true. Here's the illustration of what we are saying. In this particular case, we had day 1, right, and day 2. So in this particular day 2, we saw the Asian session range. The market went outside the box, and then it created the low. Creation of the low, whilst we are in an upward trend, if we see the US session come back and retest the low or just pierce a little bit below the low that has been set with the London session, we can enter right away. So we are saying if you are going to be using the levels counting, you need to have history of this particular direction so that you may know we are going to the upside. If you are going to use the simplified way of using the 50-200 EMA, this is where it should occur on this particular day. If the 50 crosses the 200 to the upside, we will be expecting to see an up move like that. So where do we use the TDI? Firstly, let's define the principle once again. When the market sets the high or low of day in the London session and retests this point in the US session, we expect a reversal provided that we have a bias confirming that. The TDI gives us a confirmation as how we will see in the examples. Let's now have examples snipped from real charts. Before we see examples, please note that we have a free Telegram channel where we share free setups, signals, and trading tips. Make sure you join us using the link that I'll leave in the description box below. Right, here's the first example from EURUSD. Right, from counting levels, we know that this was a peak formation high. But if we are not good in counting levels, we can see a 200 in white and a 50 EMA in blue crossing over on this particular day. So this becomes our day one. Then our day two, we had our Asian session range, right? This became our Asian session range. The market went outside to create the high, right? Creating the high and then coming back to the downside. In the US session, we retested London session's high, right? And our entry after a candlestick reversal pattern at this particular point. On the TDI side, we can see one leg outside, one leg inside, showing that the relative strength is actually dropping. So we can see our stop loss right above structure and our take profit, we would love to have it twice like that. That was a clear illustration of what we are talking about. This now is the low of day scenario. We had Asian session. This becomes our day one, right? 50, 200 crosses like that. Levels, this was holding as a peak formation low to the upside like that. Asian session. Then London session sets the initial low of day, comes back, consolidates, right? And then it comes to retest the low of the London session in the US session. At this particular point, we had a bullish engulfing pattern where we were going to get our entry. And on the TDI, this is what we have, rise of the relative strength like that. Or we can as well call it divergence. So basically, retesting of the London low in the US session like that. This was the same exact thing. Now we had Asian session 250 on the previous day, right? First low created, then London creates this low, comes back in the US session, it retests London low, divergence like that. Our entry at these two railroad tracks candlestick reversal patterns. So basically we are saying find the bias. After the bias, find the low that has been set by the London session, wait for the US session to retest that low or high, confirm with the TDI, enter the market at a valid candlestick reversal pattern, basically like that. On that note, we've come to the end of our today's video. Thank you for watching. See you on the free Telegram channel.